Hello everyone. Today is Friday, April 15th, and this is your USA Gold Weekly Review and Outlook. Yet another kind of up and down week for gold. Started the week actually with a really strong day. On Monday we were up about $25. Kind of went up and challenged that 1260 level, which is that overhead resistance. We're not able to break through that. Gold sidewinded for a couple of days, and then midweek Japan came out and basically said a lot more about cutting rates and throwing more bazooka at the problem, as they say. And dollar caught a little bit of a bid. As a result, gold went down a little bit with that. Today showing a little bit of recovery, kind of trading in the 1230 range. So to start there with Japan, and again throwing their bazooka out at things. We've seen this before, Pete.
Right. The governor of the Bank of Japan, in a speech here in the United States this week, basically said that we're prepared to do even more. And of course, there's not a central bank out there that has already done more than Japan. I mean, They are buying everything in the kitchen sink. They've cut some of their key interest rates below zero into negative territory. And Kuroda said that they're prepared to do more asset purchases, different types of asset purchases, and do more with interest rates too, implying deeper into negative territory.
So even going further and further. But what I've noticed about this is it is kind of like the competitive currency devaluation. It's just an extension of that idea, where it's who's going to do the most and who's going to do more and who's going to create an economic improvement through these mechanisms. But it's always so short-lived, and it's a lot of tongue flapping. And I feel like it doesn't really end up achieving much of anything. And you look at the short-term blip in the trade this week, and it's just, I guess, an extension or evidence of that.
Right. Well, it's interesting that Japan has to fight this perception of being a safe haven currency. The yen has to fight the perception of being a safe haven currency, which is fascinating to me. But nonetheless, it has been underpinned by safe haven demand. And the Bank of Japan seems adamant to sort of undermine that mentality and push it lower.
And it is kind of a competing force. It's they're fighting against that very idea, and they're trying to weaken their currency. I mean, 250% debt to GDP. It's outrageous where they've gone. So many demographic problems in Japan, and this is just the way they keep going with this. And I think in the short term, it causes this strength in the dollar as there's that kind of currency rebalancing. But in the long run, it just points to gold again, because it's just all about disrupting the value and confidence that people have in currencies.
Right. I think what you need to do is sort of disregard the currency movements and think about the underlying fundamentals that are driving this. And the reality is there is a day of reckoning coming for Japan, and it is going to be brutal. And consequently, and perhaps not surprisingly, gold demand is very strong in Japan right now. The largest bullion retailer in Japan reported a 35% increase in demand in the first quarter.
Yeah, well, it's interesting and not surprising. It's a lot like the United States, like anywhere when you can't earn any yield in a bank and you have a government trashing your currency. Why would you continue to hold your savings in it? Doesn't make any sense at all. So the other big piece of news this week is the launching of the Shanghai Exchange Fix, basically their participation in setting the gold price. It's been a long time coming. We originally covered this, going back about a year. My father's been covering it. Wrote a great article, Will the Shanghai Fix the gold price or fix the gold market? And it is really interesting because the emphasis of the Shanghai Fix is going to be more on physical gold versus a lot of the former, really especially the London Exchange, settling more on paper contract basis. And so it really does highlight this dichotomy between the paper price of gold and the physical price of gold. I think that's where Shanghai is important, Pete.
Right. And so I think that's the most important thing right now, because we're not sure exactly how this is all going to play out. But the most important thing is that China, the world's largest producer and world's largest consumer of gold, is exerting more influence on the gold market, or is basically insisting that they have more influence on the price of gold. And so that's not surprising. You make a really good point. They are absolutely more physically oriented than the London market, and that's can play out in some interesting ways potentially, particularly in arbitrage opportunities. If the price of gold is pushed down in the paper London market, it's a great opportunity to buy physical in Shanghai on the fix.
Right, which is what a lot of people have been claiming has been going on as, the gold prices fell, back in 2013 especially. There was this unbelievable demand out of China, and many would contend that a lot of the gold flows out of the ETF, for example, which was a huge physical outflow, just ended up in China at a cheaper price. And when you have a country like China who is so concentrated on acquiring and accumulating physical metal, not only are they the largest producer, they're the largest consumer and importer of gold, going back about a decade now. And so it's been an ongoing process, and so now them taking a seat at the table, so to speak, in price discovery, but doing so more in the physical market is important because, as anybody knows, the physical market is infinitesimally small compared to the proliferation of the paper market in gold, much as it would be with a currency system. It's all a very comparable setup, and so to see what gold does and to see how gold behaves in the physical market versus the paper market is going to be a really interesting paradigm moving forward. We've been calling for it for a very long time, of a separation between the paper price and the physical price, because at some point there's just not going to be enough physical to satisfy the demand.
Right, and that is probably already the case, but I think that it's going to become more widely recognized in the market.
Yeah.
That there's 100 plus ounces of paper gold for every single ounce of actual physical gold.
Exactly.
That can't go on forever.
Okay, as soon as you have one delivery issue, it changes everything. Which
Indeed.
brings us to our golden gong for the week, which is from John Butler. He's the Vice President, Head of Wealth Services at Gold Money, based in the UK. He says, quote, "It's increasingly unclear that the paper gold market and physical market are as linked as they should be. Someday, there's going to be a delivery issue. A mismatch between paper and physical plays would redirect the market more toward the physical and would facilitate rising positions in Chinese contracts." True enough, John. Speaks to what we were talking about today. Golden Gong. I'm Jonathan Casares.
I'm Peter Grant.
See you next week.